Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. You're watching Indian Open and I'm Neeraj Shah. Good morning, Neeraj.
Good morning, Neeraj, and a very good morning to all of our viewers. Let's straight down to the headlines this Monday morning. IDFC Bank and Capital First announced the merger, creating a lender with a diversified portfolio spread across corporate, MSME and retail loans. 5 investors will pick up a little less than 4% stake in HDFC Limited for around 13,000 crore. Brokerages maintain their stance on Infosys after the IT giant meets estimates in the third quarter, sticks to its revenue guidance for the current financial. And 7 representatives from the Bar Council of India meet Chief Justice Deepak Mishra, say they are confident that all judges will be able to resolve their differences.
Well, let's take a look at the trade setup for the morning. Remember, just a quick recap for people who want to kind of forgotten what happened last week. While it was a flattish week, it marked the 6th straight week of gains for the Indian bourses, and which is pretty heartening. And last week we had strength from unusual quarters as well. Technology gave in a lot of support at the broader end of the spectrum. Nifty Realty did reasonably okay for itself for the week gone by. And speaking of the third largest pocket, which is banking and NBFC, I think there is enough and more reason to know that that pocket will be very, very active in the session today, in the week today. I think HDFC and Capital First individually have ensured that the NBFC space remains in the focus today. And I think HDFC Bank, Yes Bank and a couple of other lenders who come out with results will ensure that for the week as well, we'll have a fairly busy time watching the banking space. After what IndusInd Bank and more specifically when Karnataka Bank did, the expectations be heightened about what happens to the banking space by and large. Keep in mind, I think the Apollo Micro IPO, which was the first IPO that came out in 2018, kind of sets the tone of what will happen in the primary market as well. Definitely shows that there is appetite where the valuations or the growth seemed all right. Now, what could happen in trade today? Anybody's guess. We'll talk about individual stocks, but remember, the markets are set for a good start. If you just look at what the US markets did in Friday's session or what the Asian markets are showing today, what the SGX Nifty is showing today, we'll have a start in the green. This is what the US markets did in Friday, and now the SGX Nifty will come up on your screen about 1/3% higher. So we'll have a start in the green. So that looks promising. The question mark only is, can we build on during the course of the week? A fair set of numbers coming out, much more than what happened last week. So it will be a busy week for sure. Stocks to watch. I'll start off with the big one, Infosys. You could have argued at HDFC too, but let me start off with Infosys. It was an inline quarter. I think if you just look at across the brokerage space, almost everybody is happy with the fact that the outlook is steady, and which is encouraging from an Infosys shareholder perspective. So don't expect any fireworks, but don't expect any kind of a pullback either. IT anyway seems to be in a slightly strong space right now. So expect Infosys to be to not correct, if you will. HDFC could be an interesting one. I mean, this was no news, but the fact that they're going to raise the money and again, that whole dilution in the book value per share, the expectation of growth, not because of the fundraise, but generally, all of that leads to maybe some mathematical upsides for HDFC. Again, I'm quoting brokerages out here. They've come out and said that there is a likelihood of some bit of an uptick coming in, if not today, then over the course of the next 3 odd months. Do watch out for HDFC Limited. This could be an interesting one in the session today, as also the course over the next few days and weeks. It's a heavyweight. It'll make its presence felt in the top contributors list today for sure. I think the most interesting one is Capital First, and we'll have a detailed chat in just moments from now. But I'm choosing Capital First because the IDFC Bank deal, just purely mathematically, values the stock at about a 12% premium to Friday's closing. So there could be, in all probability, a bit of a rally in Capital First. You could argue that what if IDFC Bank falls, but that wouldn't happen. So you would expect some fireworks in the Capital First stock in today's trade, and we'll talk about that. And then a couple of small names. One was Granules India. There is an FPI limit in Granules India, which has been increased to 49% from 24% earlier. That could be active. And BEPL, or Bhansali Engineering Polymers, very good set of numbers. Again, something that we'll talk about in the research huddle. But do watch out for BEPL. This one had a dull day on Friday. Could see some bit of traction in today's session. However, let's tell you what is lined up on First Word today. It's a collection of the editorial chats that we believe is the most important for the day. And in today's session, I guess Capital First, which is IDFC Bank's latest bet on increasing its retail play, should be interesting. But is it a win-win for all stakeholders? And what are brokerages making of the third quarter earnings of Infosys? and more importantly, its future guidance. These are a couple of chat points that we've lined up for First Word today. But let's start off with IDFC Bank and Capital First. They merged their operations, creating a lender with a portfolio which is substantially larger than what the current portfolio would be. Ida is first joining in to throw some light on what this means for, well, maybe both of the entities or the combined entities. Ida.
All right, so let me just start by saying that the first thing to note is that this is a deal which is much cleaner than the previous deal that IDFC and Bank had tried to stitch up. I say cleaner because firstly, this is a firm deal being announced. There's no ambiguity about talks starting, etc. There is no confusion about shareholders and whether the Reserve Bank of India would be comfortable with the shareholding. So the first thing to say is that this is a clean deal. So, that's good news. Now let's start talking about what exactly happens and why each of these two entities would want to go ahead with this deal. Let's start with IDFC. This is sort of the matrix between what IDFC Bank gets, what Capital First gets, and what the combined entity looks like. What IDFC Bank gets, and this is clearly a deal which was being pursued by IDFC Bank, is that they get that much coveted retail loan book of about 22,000 crore. Now, IDFC has been an infrastructure lender. They continue to have strength in that. Whatever little bit of retail they've done, they've sort of, just about struggled and managed to make it. So to be able to get a 22,000 crore loan book in the retail and SME segment is valuable for them. They get those customers as well, and hopefully once those customers are within the IDFC fold, you can go ahead and target more products, particularly deposit products, to them. The third and actually most important thing is that they get a team which understands retail banking. V. Vaidyanathan is going to be the CEO of the merged bank. He's a veteran of the retail banking space, first with ICICI and then building that platform in a non-banking financial company. So he gets retail. And if IDFC Bank from here on wants to be as much a retail lender as it wants to be a corporate lender, then they needed somebody who really got retail. And unfortunately, the IDFC current team did not have that expertise. So they get that retail banking team along with the retail banking book and a customer base. Now, this is certainly a deal which has more for IDFC Bank than it has for Capital First. I'm not talking shareholder-wise, I'm talking fundamentally because, Capital First was doing well. They had a decent business. They'd built a decent business from scratch. What they perhaps get is a balance of a retail book and a corporate book. And in that, I want to mention the timing of this. Remember, we've seen a retail upcycle. We've seen a flat cycle on corporate loans. At some point over the next 2 years, you will see the capex cycle pick up and corporate loans pick up. So at that stage, perhaps the combined entity will be in a better position to take advantage of the corporate loan cycle. I'm curious to ask the management as to whether they want to get back into project financing or not. But assuming that they do, because that's the DNA of IDFC, they are now well positioned to take care or take advantage of a retail cycle and a corporate cycle. They have the potential to raise low-cost deposits, and I put potential in inverted commas because IDFC has no retail deposits to speak of. 5% CASA or 6% CASA is very, very minimal, and it's a crowded urban and semi-urban banking market. It's not that easy to get CASA deposits. All the customers that they lend to are people who already have banking relationships. So you have to offer those customers something quite dramatic to be able to get them away from their existing banking relationships on the deposit front to come to you. So that becomes the big unknown, but the potential to raise low-cost deposits is there because you now have a universal banking platform. Again, that universal banking platform, is a coveted thing of the past. Today, I'm not really sure whether it should be coveted as much as it was, say, 10 years back when Mr. Vaidyanathan was perhaps at ICICI Bank. The combined entity, wholesale loan book of about 50,000 crore, retail and SME loan book of, around 40,000 crore. These are back-of-the-envelope calculations, not exact numbers. Again, mostly a wholesale funded bank, so, sort of susceptible to volatility in the wholesale funding markets and, minimal success. I've already said that in terms of raising low-cost deposits. A quick point on the bad loan ratios. IDFC Bank's bad loan ratio is currently at about 4%, but remember, this is after they have done a substantial cleanup by selling to ARCs. There's nothing wrong with selling to ARCs, but the short point there is their credit quality performance in the last cycle was as good or as bad as any other corporate lender. So, it's not like you have a whole lot of comfort on their credit quality side. Capital First, their NPAs are at 1.63%. Again, I say that with the caveat that Mr. Vaidyanathan's book, especially his SME book, has not yet been tested in a down cycle. But as things stand, the gross NPA ratios are more or less comfortable on the face of it. I just want to make a bigger point. This is the deal right now. now. The bigger point is what is the landscape that IDFC and Capital First will be navigating. This is now a very crowded financial space. You have 21 PSU banks. Even if you say that some of them are under prompt corrective action and hence not in a position to grow, there are enough who will be in a position to grow now that the government has committed 2.11 lakh crore in capital to them. You have 15 private banks. You have 10 small finance banks. You have about 33 NBFCs only in the BSE 500. This is a crowded space. No matter which segment you want to look at, it's crowded, and differentiating in this kind of a market is not easy for anybody. So when IDFC and Capital First combine, and the last graphic will come up on your screen, they will be navigating that really tough tough and competitive environment. This is just a quick, again, rough and dirty pecking order in the private banking space. HDFC with more than 9 lakh crore in assets is by far the top. ICICI Bank, Axis Bank, Kotak, yes, follow. IndusInd, IDFC somewhere at 7 with RBL following. So if they want to actually make it up that pecking order, it's going to be a long race. So while we understand that the deal is a good one, it's far better than the Shriram IDFC Bank deal. It has benefits for IDFC Bank. It has benefits for Capital First. But let's not get excited. That's a tough road ahead for the combined entity as well to make a mark in banking.
Yeah, but Ida, the only question is, what's this probably the best way out for both? Forget from the shareholders' perspective, purely from a business perspective, that IDFC Bank, which wasn't quite succeeding in that retail franchise, and I think I saw your point wherein you mentioned that they get an experienced team which has got the knack of cracking the retail MSME space, and Capital First, which was growing at a good pace, yes, but now gets access to low-cost deposits, because that's the argument that I've seen across the board, that they get access to the low-cost deposits which work. So is this the best way out, even though it's a crowded space, but individually they would have to navigate in the crowded space any which ways? Does this kind of make more sense?
So for IDFC Bank, yes. I mean, firstly, there are enough people who have argued that IDFC should not have become a bank. They should have stayed an infrastructure lender, but that's a thing of the past, so let's not debate that now. If IDFC Bank had to go forward, they had to acquire. They were not being able to grow organically. So yes, for IDFC Bank, this is perhaps the best deal out there. Capital First, I'm actually not convinced. They could have continued as an NBFC, and this whole low-cost deposit thing is a bit of a boogie right now, At 6% for IDFC and the merged book, even lesser than that, it's very minuscule, the access to low-cost deposits. They have to now prove their mettle and go out there and build that low-cost deposit base. And plus, remember, along with it come regulatory costs, CRR costs, SLR costs. A lot of that is going to take away the benefit that you get from supposed low-cost deposits. Yes, it gives you the access, but you have to build that access and you have to get that into your bank accounts. So yes, maybe they will have success. Like I said, Mr. Vaidyanathan has done this. He knows the landscape. Perhaps he has a strategy in place. Yes Bank, and Kotak Mahindra Bank have had some success in increasing their CASA ratios as a proportion of their total deposits by offering higher deposit rates, etc. Possibly these guys will be able to as well. But if you're wanting to make a mark in the bigger scheme of the banking things, I mean, there is still a long ladder to climb, certainly to the HDFC Bank level and perhaps even to the Kotaks and the Accesses. So it's going to be a long road is all I'm saying. I'm not saying this is not a good deal. It is a good deal. We completely take that point. It's a clean deal. I keep saying that. But it's a long road.
Okay. So that's the fundamental view there. Let's also take a look at it from a shareholder's perspective. And while I have my thoughts, let's first get in Shraddha Babla, because remember, the deal, for the benefit of viewers who are tuning in right now, Capital First shareholders get 139 shares of IDFC Bank for every 10 held. So what does that mean for you as an individual shareholder if you are holding either of your 2 or maybe 3 entities, if I include IDFC into the picture? Shraddha is here with an analysis. Shraddha, good morning.
Good morning. Nila, just want to throw up some data points as to how the loan book will look like for the merged entity before we go on to what analysts are expecting in terms of the stock price reaction. So if you see, for Capital First, Warburg Pincus was the biggest shareholder with 33.9% stake. If you look at IDFC Bank, you will realize that IDFC Limited was the largest holder with a 52.8% stake. So what happens to the stakes that some of the largest shareholders in these companies have? Warburg Pincus, their share will fall to 9.9%, and for IDFC it will go down from that 50+% levels to about 37.6%, and we will talk more about that. But that's as far as the shareholding pattern post for the merged entity is concerned. Let's also look at how it will actually reflect in terms of the loan book. The merged entity, analysts believe, will have the retail share of the portfolio at 35%. 5%. And look at the way that compares with some of the newer generation banks. So you have private banks, Yes Bank, you had IndianOpen Bank, RBL is also at about 39%. So at least it brings their loan book tilt slightly towards the retail bit now. For IDFC standalone, retail was just about 1/4 of its loan portfolio. Just how the return ratios will look post-merger. Now, Antique and Edelweiss believe that the ROAs will increase to 1.3%, and ROEs for the merged entity could be close to 10%. It's for Capital First right now it stands at 13%, and for IDFC Bank it stands at 6.1%. So bump up as far as IDFC is concerned. Broadly, in terms of what brokerages are saying, Antique has said that higher provisioning will actually offset some of the lower borrowing cost benefits that the company could see. They were also saying that the overall growth rate for the merged entity will slow down to mid-teens. Remember, Capital First has been growing their loan book at about 27% over the last 5 years, so that will come down. And most importantly, they believe any further upside will depend on successful integration and realignment of that entire liability strategy. So that's as far as Antique broking is concerned. Edelweiss says that the merger will be synergistic and value accretive as well. With respect to the other features, they've said that this is an opportunity to build a robust banking franchise. They also see overall they will have an established platform with a diversified portfolio, enough capital and potential for sustainable growth. So clearly the merged entity prospects look better. They've just said that the deposit ramp up and priority sector lending could present a challenge in the near term, but on the longer term the benefits are a lot more higher is what the broking firm is saying. So let's quickly also look at what ratios or multiples some of these brokerages expect the share to trade at. I mean, the merged entity they believe will trade between 1.75 to 2.2 times. Now, currently Capital First price to book value is at about 2.6 times, and for IDFC Bank it stands at 1.3. So you can see how that will rise. If we look at what the brokerages are saying about how the stocks would react today, Capital First, this is a no-brainer. 10 to 12% upside is what Antique is saying, but they see no near-term upside as far as IDFC Bank is concerned. Edelweiss, they have retained a buy rating on Capital First, but increased the target price to 1,033. On IDFC Bank, they have maintained a hold, but increased the target price to 74. Now, having said that, clearly Capital First, everybody expects an upside, but when it comes to IDFC Bank, there are divergent views, because while logically the stock price should correct today to adjust to the swap ratios that were announced, because Capital First was saw a 12% premium in terms of the merger ratio, but IDFC Bank, some people or some analysts that I spoke to were also telling me that there's another angle to it, that people may not really focus on the valuation aspect, but the fact that there is at least some growth and future for IDFC Bank. And again, Vaidyanathan taking the helm may also be seen as a positive, and the stack could actually react positively today and not fall that much. You have Reliance Securities, which has said that the merger ratio benefits both. And that's the picture. Having said that, let's also take a quick look at how the share price of some of these companies have already done. So if you look at Nifty Bank in the last 1 week, it has risen just about 0.5%, where IDFC Bank has run up 16%, while other banks have come nowhere close to about the kind of gains IDFC Bank has seen. Capital First rose about 15%, whereas other NBFCs have risen anywhere between 9% to seen a loss of 6%. So clearly the markets have been pricing this in as well. And Neeraj, just a thought on IDFC Limited. People are also expecting that since their stake gets diluted, you could actually see some negative reaction on that one. And Shriram Group of companies, ideally it has no effect, of course, directly, but indirectly, I'm not sure if there's a negative sentiment impact that we could see.
Oh, I know. Okay, let's wait and watch. Thanks a lot for that, Shraddha. But interesting. I think that says it all. You know, we can go on with this, but I think we are way over time. So let's move on to the next topic as well, because while we've discussed at length what will happen to Capital First, which will likely go up, the question mark is also what will happen to Infosys, the IT biggie, which has come out with the first earnings announcement after Salil Parekh took over. Now, we all know what the numbers were like, but Agam is here to give us a quick snapshot of the key takeaways and maybe what brokerages are saying. Agam, good morning.
Good morning, Neeraj. So as you've said, numbers largely in line. It's a quiet quarter as what we were expecting, with 1% dollar revenue growth in line with Bloomberg expectations. They maintain the guidance around 5.5 to 6.5% for the revenue growth for FY18, with margins guidance also the same, between 23 and 25%. Moving in, we did see a big profit boost, but that was on account of the advanced pricing agreement, because of which we saw a reversal of $225 million. In terms of verticals, we continue to see slackness when it comes to financial services and manufacturing verticals. On the other hand, their other larger vertical, energy, has done reasonably well, which saw an uptick of around 2.5% on constant currency growth. And of course, when it comes to geographies, business in North America continues to be subdued. On the other hand, we have seen a little bit of an uptick in the European business, as we have seen in case of Tata Consulting Services. What do the brokerages have to say? The ADRs did close down by as much as 2.7%, but a lot of these brokerages are positive as far as the Infosys goes. So Credit Suisse maintains a neutral, but it has raised its price target to around 1,100 from 1,000, and they say that the US financial services look soft, but the management outlook is positive. CLSA maintains a buy. It has also raised its price target to around 1,300 from around 1,230, and says client mining stayed strong and solid growth in the top client. Excuse me. And finally, we have Edelweiss on Infosys. They maintain a buy with or rather they've upgraded the stock to a buy from a hold, and they've raised the price target around to 1,265 from 1,010, and they said that barring FBFSI, all the other verticals have done well. That said, we do have a new head right at Infosys. So the new CEO and MD Salil Parekh has spoken a lot about the outlook. So let's listen in as to what he has to say about the most immediate challenges facing Infosys.
There's work on what is the market opportunity. There's work on our client relationships. The people dimension is very critical. And then there's work on how is the service portfolio rejuvenated. So those are the real elements that we are digging into. And from that, with interactions with our clients, with employees, with our partners, over the next 2 or 3 months, I will complete the exercise. Our focus today is to make sure that as we grow into the new areas, we offer the opportunity for reskilling for all of our employees. Beyond that, we have in all of our operating metrics already shown a high level of utilization. We have a real strong demand in the market.
All right, those are a couple of the big stock-specific stories that are in focus. But the macro story to focus on is data that came in on Friday, both consumer price inflation and the industrial output numbers. I'm going to start with the consumer price inflation numbers because those tell you a slightly more consistent trend story, and then we'll talk about IIP. So CPI came in at 5.2%, not particularly different from what was expected. The expectation was about 5.1%. But the fact that you have now seen a steady trend up all the way since September, and you're well above the 4% mark, which is the midpoint of the Reserve Bank of India's or the MPC's inflation target band, which is 4% plus minus 2%. So it basically makes the point that the Reserve Bank of India was correct in its assessment that inflation is now going to start rising, and hence it does not have much room to cut rates. In fact, any limited room that people would have anticipated also seems to have shut unless there is downside surprises that come in the first couple of months of 2018. At 5.21%, the index is being driven higher by a year-on-year increase in vegetable prices, although month-on-month vegetable prices have softened a little bit. You're also seeing upside coming in from certain other items like the housing segment within the core, because that segment has an HRA component. It's slightly technical, and the RBI said it will look through some of the inflation that is coming in the housing segment, but still, those are some of the elements that are pushing up the consumer price inflation numbers. The IIP numbers that you got were, well, there was a lot of attention on the IIP number because it was very strong, and November IIP at 8.4% was certainly well ahead of what markets were expecting. The consensus expectation on Bloomberg was close to 4.4%, so well ahead of that. But there is still a bit of a distortion. There is that digestives and enzymes segment, which is still growing very rapidly and adding about 2 percentage points, a little bit more than that, to the headline number. So the actual number is closer to 5.5%. But within that, the manufacturing segment has done very well. You've got a near 10% growth in and manufacturing. That was encouraging. You had mining, which was flattish, and electricity, which grew at about 3.9 odd %. But capital goods, tying into the manufacturing strength, strengthened further. We've had 4 months of strength in capital goods now, going from negative 1% growth in the month of July to now 9.4%. The infrastructure and construction segment, a newly created segment under the new IIP series, also saw strong growth at 13.5%. But almost everyone that my colleague Azman spoke to while writing the story on the macro data said that they will wait for a few more months to see whether the strength in the industry sustains. There is some recovery, everybody acknowledges, but the strength and the pace of that recovery still remains questionable. Inflation, on the other hand, is very much on the upside now, and that sort of shapes the nature of policy in 2018.
Well, that's all that we have for you on First Word today, but stay tuned because we'll talk about market and valuations and earnings with Dhananjay Sinha of Emkay Global, a long-term capital gains tax controversy with Pranav, Sayta of EY, and Ketan Dalal of Analyst Advisors. All of that coming up in a while, but for now, we'll take a quick break, come back, we'll full tilt towards the day's trade.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people.
Welcome back and good morning. I'm Pradeep Pandya. You're watching Indian Open. Let's go across to my colleague Navneet Saluja now, who is standing by with details on FNO setup this morning. Good morning, Navneet.
Good morning, Pradeep. Well, we're looking at fresh highs in today's session, as SGX Nifty suggesting a gap up opening above the mark of 10,700. So this is how the trade panned out on Friday. No major build-up when it comes to Nifty futures, but the action is actually now on Bank Nifty futures, which is yet to register the mark of 26,000. So look at this. There was a build-up of almost 12% on the Bank Nifty futures, telling you that there were some fresh long positions being seen here. The other good news was the India Volatility Index. That cooled off by as much as 2%, but still it is above the mark of 13.5, and usually the derivatives analysts watch out when the India VIX recedes below the mark of 12.5. So watch out for that in today's session. Well, in terms of what's happening with the Nifty PCR, this has been a concern, but still the markets are touching newer highs every day. Nifty PCR is almost at 7-year high now. 1.74 is the level, and the Bank Nifty PCR is hovering above the mark of 1 right now. In terms of option strikes, well, once again there was huge amount of put writing, and essentially that's the reason why the Nifty PCR has been at higher levels. So 10,000 put strike, the red bars are your put strike, saw a huge amount of writing, followed by 10,600. This is the level where the support comes now, 10,600. So do watch out for this in today's session. And there was unwinding when it came to call strikes, telling you the call writers ran for cover when the markets are touching newer highs. In terms of a broader range for the January series, it is between the 10,600 to about 11,000 strike right now. What did the institutions do then in Friday's session. There were huge amount of long positions seen on the index futures. FIs added almost 6,200 contracts, though they did add short contracts as well, but net it was a long addition. And look at the options data, that looks pretty encouraging. On the call long side, it's not every day that you see addition of almost 20,000 contracts. A huge amount of long positions were added here, and also on the call short side we did see some significant amount of addition. In terms of stock futures, there are 13 stocks now which are in the F&O ban, and these are the newer additions: Dish TV, Jain Irrigation, Kaveri Seeds. So do watch out for these counters in today's trade.
Watch out for all of these. Navneet, many thanks for joining us and giving us that perspective. Let's get in Abhijit Phatak, Director at Definite Solutions, joins us on the show. Abhijit, I don't quite recall what was the thought process on Friday, but we are likely to start off fairly well in today's session too. How does one approach the Nifty as a trader?
Good morning, Neeraj. Nifty is still in that range of 10,600 to 10,750. It has still not reached 10,750, and it looks like it might do that today. And fresh longs at these levels, I'm still cautious about going fresh long based on the options data, which is there at 10,700 and 10,800. So I guess if anyone gets, if Nifty futures trade near 10,730, it might be a good idea to short it at open with a stop loss of 10,755, where maybe for a 30-40 point dip towards 10,700, maybe 10,680 also.
Okay. And what are your trading ideas this morning?
Which is still looking bullish to me. It is still range bound, but it might break out any day. India Bulls Housing Finance, if buying near 1225, 1230 futures with a stop loss below 1210, it can go towards 1245, and a close about 1250 will take it to maybe even 1300.
Abhijit, there's a point that you wanted to make on the dollar index?
Yes, that's $30, which is traded on the BSE. Traded in the sense it is listed on the BSE. And if you see the long-term chart of this $30, it is nothing but a dollar-based Sensex, and that it had a top which is a 10-year-old top at 4430, and that 4430 was broken. I mean, it was crossed last week, and it has consistently remained above 4430. So that is something which is a very big long-term chart, and that indicates a very big breakout. I mean, of course, it's just a ratio chart of the Sensex and the dollar. I mean, the USD INR. But that is something which I'll be keeping a close eye on. If it consistently keeps above 4430, let's say 4400, that is giving a very big bullish sign on the Indian equity market.
But what is the significance of tracking this index actually, Abhijit? Since you have raised it, I would like to just get some clarification from you, because what it means is probably if an FII had bought years back and has been holding on, will now start making money, or the dollar return will rise. But does that really affect the FII's behavior in Indian market?
No, it actually means two things. One is the Indian equity market is outperforming the USD INR, because it is nothing but a ratio chart. So which means that if someone is looking at going long in the USD INR, he needs to be cautious, because that is a very, I mean, it's not a good sign for the USD INR. It might be going up towards 60 maybe. At the same time, like you said, for the last 10 years, if you follow only this index, anyone who has, I mean, it is going into positive only after 10 years. After 4430, it is trading above 4430 only now. So that is a sort of a breakout on the charts.
Okay, so that's the call coming in here. And Abhijit, if you have looked at some of the names which are in news, and if you could tell us how much of the news is priced in, like for example in case of IDFC, which is raising funds.
IDFC is still a bullish chart, but it needs to cross 1800, 1810 decisively, and I mean, it is still bullish if it opens near 1800. And one can buy above 1810, but at the same time it has a good support near 1700, so it is still range bound between 1700 and 1800. If it opens flat, one can go long with a stop loss below 1710, and if it opens near 1800, one should go short, because unless it crosses 1810, it might come down.
Well, that's the chart view. Abhijit, many thanks for joining us today, of course, and giving us that perspective. So if you just look at fundamentally, because of this fundraise and of course the expected growth rate, not that the fundraise will dramatically alter the landscape, because a large portion of the funds will be used to maintain the stake in HDFC Bank, which will also see the fundraising. So HDFC's large portion of the fundraise is happening because of that. But keep in mind, for a financial name, fundraising means a drop in book value. In order to come back to the average book value, the stock price has to go up. I think the CLSA note says that on a 5-year average of 2.5 times price to book FY19, HDFC post this fundraise would be trading at 2.1 or 2.2 based on the expected growth rate too. So there is that much of a premium, about 10-11% premium that HDFC could get over the course of the next, I mean, they would cite our next 1 year, but essentially in the next some time. So if the markets stay buoyant, expect some bit of fireworks in this big boy too. I would stick my neck out, Pradeep, and say that today it will make a mark on the contributors list. It's anyways a heavyweight, could be active today. So let's wait and watch HDFC today.
Definitely. It's usually there, and
today more so.
Once there is a news, I think it should.
Yeah, okay. So before we move any further, a quick check on the commodity markets as well, Pradeep.
So commodity markets are basically driven by what is happening with dollar, and dollar index has broken down. There is all possibility that we'll probably touch 90 before we find some kind of support. That's the view coming in from FNO traders. So if you look at the impact of that on most other commodities, it's going to be positive because all the commodities are traded in dollar. So the impact is most significant on gold as usual, because gold has been rising on falling dollar, and therefore it has hit a new high, new swing high of around $1340 or so. So that is on expected lines, but that is not the only commodity that benefited. The other base metals have also benefited, although overall, if you look at the trend in base metal segment, it's more or less mixed. So what we really see with base metal is that although there is some support coming in from Chinese data, zinc has hit a decade high, aluminium has also gained, nickel, tin also edged up on LME on Friday. But on the other hand, there was some pressure on copper and lead. And also this morning, if you look at the Asian cues in Shanghai, steel has also opened a little weak, down by around 1% or so. So that's the kind of mixed trend that we are getting in spite of falling dollar. If you look at crude, it's close to $70, kind of holding on. What may not support crude prices at this level is rising rig count in US, but on the other hand, you have some bullish noise coming from OPEC countries, which kind of supports the continuation of production cuts in spite of rising crude. So that kind of holds the crude prices at current levels, and we'll have to probably wait for the next decisive move. $70, as I've been maintaining since last week, is very significant. This could be a make or break level.
Let's wait and watch if that happens or no. A clutch of equity stocks in focus for viewers who are tuning in right now, and our research team will speak about all of those. But the HDFC, IDFC and Shriram, IDFC and Capital First, as well as a clutch of results that have come out too. All of these would be in focus. Let's talk about all of those with Siddharth Sedani, Vice President Equity Advisory at Anand. Rathi joins us on the show. Siddharth, good having you. Thanks so much for joining in. We were just talking about HDFC, so maybe let's start off with that. While this is on expected lines, the fundraise, does this in any way change your advice to your clients, people either who are holding HDFC or want to buy HDFC afresh? Does this fundraise provide that opportunity?
Good morning, Neeraj. Well, somebody who is holding HDFC should keep holding the stock because fundamentally stock sounds good. Overall financials are stacked up very well. Fundraising can be one of the attraction going forward. But overall perspective, fresh buying in this stock, we would not recommend. Either we don't cover. Still, we believe that in the same space, we believe Indiabull Housing Finance looks the most attractive. If you want to take a fresh position in this space, I think Indiabull Housing Finance can be a good proposition to invest with a target of 1500.
Okay. Do you cover either Capital First or IDFC Twins? And what are your thoughts post this exercise?
Well, we don't cover either of them, but this exercise has been really good. I think Capital First will be gaining a lot of ground out of this. It is one of the NBFC which is really growing in a strong pace since many quarters now. We believe Capital First will get a better wing. IDFC Bank, as if there was not much of operational efficiency which was coming in, the advances was also not that great. they were struggling. So I think Capital First will be on a positive side, but one has to always check for next 2 quarters at how the synergies work, because if it doesn't work, then that can be really harmful for the stock, I think. But still, I believe that this is more positive for Capital First than the other company.
Siddharth, I'm a bit curious. I mean, not tracking a stock must be based on some kind of logic. If you could tell me why Capital First was not under coverage. IDFC Bank, I can understand. It never made money in last so many quarters.
Well, we were more positive towards Bajaj Finserv and Bajaj Finance, and we believed that leader will be moving more better pace than any other company. Of course, Capital First was having the same kind of a model, but in a smaller size. So we were more confident over the leader like Bajaj Finance rather than Capital First.
That equation changed now because you have got a bank.
Of course, but still I would say, Pradeep, that the synergies, how this works, would be very important. As I communicated the last, I would say this is a strong point, but synergies should be looked at.
Okay, so jury is still out on this probably, and we'll wait and see how things really pan out. But our research team is ready with all the bunch of stocks that you should be focusing on. Some of those we did speak about, but let's start with our research team here, Shraddha, for a change. You're talking about HDFC and not Thin.
That's right. Big fundraising. The HDFC Bank is going to raise about 13,000 crores. That's via a QIP issue and a preferential allotment as well. So the QIP amount is, they're going to raise about 1,900 crores from the QIP and 11,100 crores via preferential allotment to 5 investor groups, out of which the largest ones are Waverly, which is a GIC affiliate, Omers Canada, Silverview Investments, which is a KKR affiliate, Carmignac Group, and Premji Investments. So all of them will together invest about 11,100 crores in HDFC Limited, confirming Bloomberg Quint news break in December saying that KKR and GIC were in the final leg of investment in HDFC. How they're going to use the funds, the board has already said that earlier when the approval for raising funds was given in December. They want to participate in the preferential issue of HDFC Bank and maintain their shareholding in the bank at 21%. They have also said back then that they want to explore inorganic opportunities in the health insurance space. They were evaluating stress assets in the real estate sector, funds for investing in equity and mezzanine debt of affordable housing projects, and they were also looking to raise funds for growth at all its subsidiaries. So again, a known fact, but confirms Bloomberg Quint news break, and we could see some positive reaction. It's a big fundraise.
Definitely a big news for a big stock, a heavyweight, and we'll keep an eye on that. But what are the other stocks, Nikki?
To begin with, we have the Rediger Enterprises that the company has signed a supplementary agreement to sign the operation, to sell the operational division to True North. The value is revised and is now valued at around 1,350 odd crore. Now remember, back in April 2017, the company had entered into an agreement to sell the stake, and that was for a sum of around 13 odd crore. HDI board promoters, they have approved allotment of 200 crore warrants to its promoter at a price of 71 per warrant. This is for long-term equity infusion. Team Lease Services and Healthcare Global, there you would see the FII limit of 24% for the company has been reached, and you would not see any more buying thereon. But then do remember the fact that the stock has already reacted past 5-6 sessions. The stock has been sliding lower. Granules India, there RBI has approved to hike the FPI limit to 49% from 24% earlier. The last one is an interesting one. It's a bulk deal where Ashish Kacholia has picked up 0.9% stake in Butterfly Gandhimati Appliance. Now remember, the Kacholia already had some stake in the company as per the December shareholding pattern, and with the latest purchase, the stake goes up to 2.3%. And also you have Dolly Khanna, which is invested in this counter.
Okay, so these are some of the stocks to keep an eye on. But what's the update on result season, Jayesh?
Plenty of results over the weekend and aftermarket hours. So let's start with the strong numbers. Bhansali Engineering Polymers, that came out with a strong set of numbers. Net revenue more than doubled at about 258 crores as compared to 123 crores. Operationally too, EBITDA was up more than 4 times at nearly 43 crores as compared to 9 crores. EBITDA margin came in at nearly 17% as compared to 7.5%. And the net profit, that saw a spike of more than 9 times at nearly 30 crores as compared to 3 crores. TGV struck the other company that reported a good set of numbers. It's a manufacturer and exporter of chemicals. Revenue was up 22% at nearly 273 crores. Net profit jumped more than 3 times at about 10.5 crores as compared to 3.3 crores. Operationally too, EBITDA was up about 60% at 50 crores, while the margins came in at about 18.5% as compared to 14.3%. Syntex Industries reported weak set of numbers. Revenue was up 44% at about 840 crores, but the net profit halved at about 21 crores as compared to 42 crores. EBITDA was down 32% at 557 crores, and the margin declined to about 6.8% as compared to 14.3%. Last and final weak number reported by Reliance Industrial Infra. Revenue was down 8%, and the net profit was down about 1%. Pradeep.
Okay, thanks, Jayesh, and thanks, Nikki and Shraddha as well on all these stocks. This is the update coming in. Siddharth, RIIL, would you really look at the result or all the development that is happening around, Navi Mumbai infrastructure? There's a bunch of stocks like RIIL, Jacob, Skill Infra, even GVK Power that have been moving up. Which one is on your radar?
See, none of them are on my radar. Of course, this infrastructure talk and development has been happening since many years. Ground reality is some development is happening. But amongst these stocks, there could be only one turnaround story, that is GVK Power. We believe that they can be one of the turnaround, although high debts and a heavy balance sheet is an issue as of now. But company seems to be committed, management seems to be committed to turn it around and improve the balance sheet. Although none of the stock is under our coverage and recommendation, but we still believe for a long-term perspective, GVK Power can be one of the stock which can be a turnaround company.
By the way, look at BEPL. I think it's just going to be one big mover in the session today. A blockbuster set of numbers. EBITDA has expanded dramatically. Profit has gone up substantially. Let's wait and watch if this does react or not. Remember, it's a stock that's gained quite a bit. In the last 1 year, it's probably gone up 4 or 5 times or maybe more. But should be interesting to see what happens. This is the 12-month return, 674%. It's a stock that's gained very well, but the numbers justifying it. Any which ways, for now, full tilt towards the technicals. Let's get in our technical experts on board. So Mukesh Singh of Nila Financial Services, as well as Ruchit Jain from Angel Broking, join us on the show. Gentlemen, good morning. Thanks so much for joining in. Mukesh, a quick perspective on the index. Are you trading the Nifty today? It'll start off about maybe 1/3% higher.
Good morning, Neeraj. As you rightly said, we will be starting with a gap up, and this gap up might take up Nifty towards that 10,750, 760 kind of area, which has been, which is a resistance area according to the parallel channel in which the index has been moving for last 1.5 years. So I would readily be looking to book some profits in the long positions if someone is having, and more so the pattern in Friday's session was that of a hanging man pattern. And for extreme short term, the low of the pattern, that is 10,597, and just a shade below it, the 10,565 is an open chart gap which was left on the Nifty in last week's trading. So it seems that long holders can keep a strict stop place below 10,560 for the extreme short term. And as I said, if it opens around 10,740, 750, it would not be a bad idea to book some profits in the long positions.
Okay, so booking some profit in long positions is what Mukesh is advising. Ruchit, do you also agree? Because look at Nifty Bank in particular, which has been lagging, will probably try and face some resistance at the all-time highs.
Yeah, very good morning, Pradeep. Yes, definitely we see the Nifty Bank index, then we have seen some sort of underperformance in the last 1.5 months, where Nifty IT index, Nifty IT or Nifty Midcap have shown a good up move. This index, banking index, has probably more of seen a consolidation phase. Now the prime reason for this has been the large cap stocks within the banking index. We have not seen any kind of momentum coming in the large cap, which constitute most of the heavyweights in the Nifty Bank index. We see the last 1.5 months activity, then 25,800 has acted as a very stiff resistance, almost thrice in last 1.5 months. So it would be very crucial for this index to cross 25,800 for any kind of up move to be seen. As of now, we are not advising to create any long positions in the Nifty Bank Index. Still, it is trading below this 25,800. Only if it crosses about 25,800, then I think we should see some sort of positive momentum coming in, wherein on the higher side, we can then see levels around 26,200 or even 26,300 kind of range.
Okay, so what about specific stocks? Ruchit, your 2 ideas for the day.
Yeah, I have a couple of buying recommendations. One is a buy call in Z Limited. We have seen that this stock since last few days have been consolidating in a range. If we see the derivatives open interest activity last 4 trading sessions, it has been one of the top OI gainer. If we consider top 5 or 6 OI gainer, Z Entertainment was there in last 4 trading sessions. Secondly, if we see the Friday's volume activity, the price up move was supported by very huge volumes compared to the recent past, which indicates that after this consolidation phase of about 1.5 months, the prices are now ready for a directional momentum. And the probability is more that the directional move would be on the upside since the broader trend is positive. So we are recommending to go long on Z, keeping stop loss below 278 for target projections, 578 for target around 625. And I have one buy recommendation within the mid-cap space, which is CCL products. If we see last 2 or 3 months activity in CCL products, prices have been trading in a consolidation phase. Within the consolidation phase, prices are now near the lower end of the consolidation, whereas volume activity have been increasing significantly increased significantly in last week. So I think the risk reward ratio is quite favorable to go long at current levels. So recommend to go long in CCL products, keep stop loss below 285 for target around 327.
So 2 buying recommendations, Z and CCL products coming in from Ruchit. Mukesh, what about you?
Pradeep, I have covered Hindalco as a buy. Out of the 3 big boys in the metals like Tata Steel or Vedanta or Hindalco, Hindalco seems to be outperforming both of them. And after this nice little pullback of last 4-5 days, it seems that the short-term momentum setups have once again got into an oversold area. So one can look to buy Hindalco around 269 for a stop placed below 264. And for a probable target area around 285, which happens to be the recent high, and I am expecting a retest of that high, if not higher. The second stock which I have covered is Balkrishna Paper. The entire sector is having a dream run, be it International Paper, Ruchira Paper, or even a small cap like Balrampur. So this one seems to be quite nicely poised on the charts, and with the sector having a kind of giving a kind of the tailwind, it seems that Balkrishna Paper can be bought around 98. Stop is to be placed below 92 or 91, and target on the higher side, I am expecting a minimum push towards 121, 125, and even higher towards 140, 145 in coming few weeks.
Watch out for all of these. Thanks a lot, gentlemen. Stay on, so much more to talk about. But on to our special segment, Bloomberg Edge, wherein Jayesh Kelani gets us a pattern that is developing on the Bloomberg terminal. And Jayesh, I think the stock that you're choosing today is Mindtree.
Yes, Neeraj, that's right. Because, on Friday, the moving average convergence divergence has given a positive breakout, thereby suggesting that a buy signal could be in place for Mindtree. Now, let's have a look at how the MACD actually works. It's a momentum indicator which shows the relationship between 2 moving averages, essentially plots 2 lines, the MACD line and the signal line. And it also helps you to identify where are the turning points in a particular trend. So, how do you interpret that? The 2 lines that get plotted, a crossover between the 2 lines gives you a buy or the sell signal, depending on the direction of the crossover. So let's go to the chart of Mindtree, where we can see that, the stock is virtually trading at a high point in the last 6 months. And also that the bottom panel, which is the blue line, has crossed over above the white line, which gives you a buy signal, the positive crossover that I was referring to.
Okay. And, well, it's a stock that's gone up quite a bit already, Jayesh. What is the efficacy of this indicator?
Neeraj, if you had bought all the MACD indications in the last 1 year, net profit would be about 22%.
Okay, Jayesh, many thanks for that. Siddharth, do you have Mindtree within your coverage? There is a technical reason to maybe buy Mindtree today if the Bloomberg terminal is to be believed. But fundamentally, is there merit in buying into a Mindtree afresh?
Yes, absolutely, because we are very positive on mid-cap IT space, and in specific Mindtree, we believe that overall operational efficiencies are improving, services business are been improving, can expect around a growth of around 18 to 20% going forward. Mindtree fundamentally looks very attractive. Apart from that, also there are some companies which we really likes of Tata Elxsi and the Persistent System. But as per the technical indicators of yours, I think Mindtree fundamentally also looks very interesting for positive going forward.
Okay. Siddharth, what's your view on Syntex Industries and Syntex Plastics? Both the numbers have kind of disappointed the investors, and there are several investors who have been holding on to this, hoping to gain by a value unlocking post demerger, so they are still waiting.
Absolutely, the numbers has been disappointing. Margins have eroded big time, and there is less possibility of next improvement, big improvement seen in next quarter also, that is March quarter. So somebody who is holding it, I think one should wait out for one more quarter and look at how the results are panning out. If there is some kind of improvement, you may see some kind of a stock price appreciation from here on. I think better is to wait out for a quarter, the people who are holding. And fresh buying, I would recommend absolutely and avoid. Don't go for fresh buying. If you want to still play out plastics, or you want to play out some this kind of a business, go with consumption kind of a business. Companies like Nilkamal, I think as we know that thrust on consumption would be pretty higher. From non-organized to organized is one of the thrust which is coming on for the company. Nilkamal can be a good proposition for investments with a target of 2300.
Okay. I'll ask Siddharth about one stock idea though. Maybe although he's already given us Nilkamal as idea within that pocket. But just look at a couple of earnings. One is, of course, he spoke about Bhansali Engineering Polymers at length, extremely strong numbers. Then there's a small company called TGV SRAC, if I'm pronouncing it correctly. It came out with a very strong quarter 3. Revenues up 22%, net profit up 221%, and again, margin expansion there, 18.5 versus 14.3. So there's substantial EBITDA margin performance, as a result of which the bottom line has gone up dramatically. As you can see, it's a tiny tune, 10 crores of profit, about 275 crores of revenues. Not a very large company, but interesting one there, TGV SRAC, the stock. Let's see if it reacts well. However, if you were to make advise a fresh investment, Siddharth, where would it be? Sector agnostic. I'm not pinning you down to a sector, but if I had to ask you for one mid-cap idea.
Well, that would be from the defense space, that is Cochin Shipyard. It's one of the biggest in terms of shipbuilding and ship repair. Defense has been a big opportunity for this company going forward. The order book currently is around 8,900 crore, around 9,000 crore, which is quite considerably good for a good revenue to flow in for next 1 or 2 years. We can expect that Make in India initiative can augur well for the company, and this company can be the leader in shipbuilding for a global shipbuilding industry. Overall perspective, it has a large dry dock, and we expect this company to really perform very well and get a lot of orders from defense space. Budget can be one of the factor which this company would be benefited from. Cochin Shipyard one can look at with a target of 695.
Okay, so that's the call. That's the stock pick coming in from Siddharth.
Hey, this goes on the back of a very interesting IPO that has just gotten finished as well within that same pocket, and that should keep that entire bucket excited. Apollo Micro, I think the subscription numbers were just so strong. Admittedly, 150 crores, and admittedly it's a very wide pocket, so you can't compare one defense firm with the other. But just the subscription numbers so strong for Apollo Micro. Should be interesting to see if some of these stocks do well today or otherwise.
Yeah, and also the development that we were discussing last week, the dredging corporation might get merged with this. That's a proposal coming in from shipping ministry. So let's see how that also affects, if at all it happens. So market is right now factoring in a privatization of dredging corporation and not really a merger with this one or any other PSU for that matter. Just 40-50 seconds for market open.
Yeah, so clutch of names, I'm sure, and which will of course be in focus. The likes of HDFC, Capital First, IDFC Bank. We're interested in seeing what happens to IDFC individually as well. So that is all on the radar, and of course then a slew of mid caps as well. Granules. There's also, I think, Ashish Kacholia buying into Butterfly Gandhimati. So all of those stocks will be in focus today.
And also HDIL, where promoter is putting money at 10% premium to current market price. So let's see if that one reacts. 70 rupees is the price at which promoter money will come in, and stock is quoted below 64 in the previous session. So all set for the market open. SGX Nifty is indicating a positive open, a gap up by maybe a third of a percent or so. If you look at SGX Nifty, it's up by around 40 points at this point of time. 10,700 plus, that kind of open for sure we are looking at. 10,754 actually trying to stabilize now. Sensex is up by almost 200 points in the morning trade. Let's see which are some of the key gainers on the index. Well, there are a few codes which are out of whack, like ONGC is down 10%. On the positive side, let's see, now prices are stabilizing. Quotes that we're getting on Yes Bank is positive by 2%, HDFC Bank, ICICI Bank, so entire private sector banking is doing well. Also, Tata Steel is positive by 1%, and Infosys continues to do well after results. That's interesting. Look at some more key losers. SBI and HUL are two heavyweights that have put some kind of pressure. So here is Infosys close to 1100 post numbers, which is interesting. Some of the stocks, smaller names that we talk about, let's see if there is any movement at all in some of these. So, well, Butterfly Gandhimati is locked at the 5% circuit in pre-open trade, though this is just a pre-open number. Granules India is interestingly higher by 2.5%.
Capital First, that one, IDFC, Capital First, HDFC and IDFC Bank, all of them should come up on your screen. IDFC Bank has this uptick. Well, now this is interesting here, because currently, as per the current market price of IDFC Bank, Capital First was available at a 12% discount if the merged entity valuations are to be believed. Now, if IDFC Bank were to rally, which I don't think it will, by the way, I would doubt that we'll see a 10% uptick in IDFC Bank, but let's wait and watch. It already had a 15% rally ahead of the announcement. Keep that at the back of your mind. So this may well happen. You may well have a 10% upside in Capital First. IDFC Bank will not rally. I would doubt even a 3.5%, but let me not be a stock picker out here. But let's wait and watch. I don't think a 10% rally in IDFC Bank is possible. IDFC Limited is the other interesting one. Just pull that one up for the benefit of our viewers and see what's happening there. Again, I think these are pre-open dates. These will settle down a bit. Lastly, HDFC and Infosys should come up on your screen. The two biggies which are in news, HDFC about 1.25% higher. Brokerages, most of them bullish post this. And Infosys, I think the common chord that almost everybody had when they spoke about Infosys post numbers was that the steady outlook by Infosys is encouraging. So let's wait and watch if this one starts off margining the green or not. Remember, again, a stock that's had a 4.5% rally behind it ahead of the results. So let's wait and watch. Last but not the least, before we go to Somit, I want to mark, and before we mark the rupee, I want to mark Bhansali Engineering Polymers. I'm starting like a broken record there, but 5% higher. I'm not surprised. This could well be the rate at which we'll start off trade today. But the currency too, I think 63.44 was the rate that I last saw. Yeah, so there's a substantial pullback into the rupee in today's session, 63.45 now, but that's a very sharp pullback that we're seeing in the currency in early morning trade.
So that is probably also the reflection of what's happening world over to dollar, and a dollar index is below 91 right now. That this could be a reflection of that. Let's go across to Somit Sarkar now, who is joining us with big brokerage calls of the day. Somit.
Good morning. On the big brokerages, first we have is ICICI Direct on Himadri Specialty Chemical. Now they have initiated coverage on the stock with a buy rating and a target price of 245, which suggests a potential upside of 30%. Now for Himadri, goals visibility is healthy with impressive capex and firm financing plans amid robust product demand. And when you see product-wise, the coal tar pitch is a cash cow and the dominance on the same is expected to sustain. SNF, which is a construction chemical, has a big opportunity according to the brokerage, and carbon black industries in a sweet spot, and Himadri will be a key beneficiary out of this. When you see the financials of the company, the debt is at a control level and debt to equity is steadily on a decline, and the brokerage is expecting the company's revenue, EBITDA and net profit to grow at a compound annual growth rate of 23%, 29% and 38% over FY18 to FY20. Lastly, the brokerage is expecting Himadri to command premium valuation when compared to its peers. Second, we have is Equirus on Whirlpool. Now they have initiated coverage on the stock with an ad rating and target price of 1,717. Now the company will look to plug its portfolio gap to drive incremental volumes and to improve its brand image. Going forward, expansion in distribution network and new product launches would drive growth, and the revenue growth would be powered by refrigerator, washing machine and air conditioning segment. When it comes to the refrigerator segment, the penetration level is expected to increase to 43% by FY22. In washing machine, it will be the fully automatic machine which will drive the growth, and when it comes to the air conditioning segment, it will be the split AC which will lead the way going forward. Now, the brokerage is expecting the company's revenue, EBITDA and net profit to grow at a compounded annual growth rate of 19%, 21% and 20% over FY17 to FY20. Lastly, the brokerage says that the stock is currently trading at reasonable valuations.
Okay, Samit, many thanks for that. So we'll watch out for a bunch of these names as well. I think today the newsmakers outweigh the brokerage calls by a wide margin, and a clutch of these would be reacting. Though I must say, as the pre-open rates are stabilizing, there's a flash trade in PC Jewellers. I think this will change. But as the pre-open rates are stabilizing, IDFC twins are settling down to about 3.5% kind of a gain. Capital First is rock solid at about 10%. So that one might well start off well at 10% higher. But the IDFC twins just cooling off a bit. Infosys interestingly is cooling off or showing signs of cooling off. Let's wait and watch. Now down about 2.5% from a 1% higher uptick. Let's wait and watch what happens in the next 3 minutes. But while we wait for all of these to settle, it's that time wherein we tell you what various mutual funds have done in the month gone by. So Reliance Mutual Fund increased stake in Punjab National Bank and Bharti Airtel, but exited the PSU players like BEL and SBI. Jayesh, what are the details?
Morning, Neeraj. So, their total equity assets are nearly $15 billion now. In terms of the sector allocation, they have about financials at about 28% of their portfolio, followed by industrials, which stands at nearly 16.5%. With that, let's have a look at, what their activity was. The top activity wherein they increased stake. Punjab National Bank, you started off with that. They added more than 1 crore shares over there, followed by Union Bank, where they added 94 lakh shares. Bharat Financial, they've added about 14 lakh, and TCS, they've added more than 5 lakh shares. Bosch, the other one, in which they added about 86,000 shares. In terms of where they have decreased their stake, the clear standout sector that you can see over here is the banking space, the large cap banking. In fact, SBI, they reduced about 47 lakh shares. TVS Motors down about 21 lakh shares. IndusInd and Yes Bank also, they reduced about 12 lakh and 1.7 lakh shares over there. Maruti, which touched intraday high of 10,000 rupees during last month, they've reduced 1.3 lakh shares from their portfolio. In terms of where they have picked up stake fresh in the month of December, have a look at this. LT Foods, they've purchased a fresh to the tune of about 47 lakh shares. Greenply Industries from the building product space, they added about 27 lakh shares. Future Supply, 4.1 lakh shares added. Just Dial and Godrej Industries, few of the other names which made their way into the portfolio of Reliance Mutual Fund. In terms of what they have sold off completely, Infibeam is the big name that we are spotting over here. 12 lakh shares they've reduced or they've completely sold off. PC Jeweller, 5.5 lakh shares gone from there. Mindtree, they've sold about 1.2 lakh shares, and Escorts about 1.9 lakh shares gone from there, as well as SRF goes out of the portfolio of Reliance Mutual Fund.
Well, thanks, Jayesh, for the update. What's really interesting, PC Jewellers, Mindtree, some of the stocks which are in a strong uptrend, they have reduced their position. What you also find interesting is what happened between Bharat Financial and IndusInd Bank. One is bought and one sold, but PSU banking is where mutual fund is actually positive. Reliance Mutual Fund has, though, reduced some position in SBI, but bought into PNB and Union Bank. Even if this is a strategic move, it means you are taking or increasing bets on riskier PSU banks because you expect maybe a recovery in asset quality, and therefore you'll be able to make more money. Or dear Siddharth, do you agree with that view? Is it time to buy into stocks like PNB, Union Bank, or those stocks which are quoting at a discount to SBI?
Yes, of course, because there is a lot of opportunity available in some these kind of banks. SBI, of course, we are positive as a front runner. But if I want to pick and choose from the mid-tier sort of companies, which is valuation-wise little cheaper than SBI, then I would like to go with Indian Bank. I think here the advances growth numbers will improve. Slippages have, of course, seen some kind of a plateau. But overall, we believe that here the operational efficiency will improve, overall financials will improve, NIMs may harden up a little bit. So Indian Bank in the mid-tier PSU banking space looks most interesting to me with maybe 6 to 12 month horizon.
Okay, I'm just looking at stocks which are moving around. Mukesh, pull up the chart of IRB Infra. It's looking slightly active. I mean, is there a trade in IRB?
Neeraj, this particular stock has got a tendency of sharply running higher, and then the price uptrend suddenly stops. As of now, late October highs are placed around 255 kind of areas, 252 to 254. If it is able to get past this particular value area, then the next set of resistances are placed around 265, 270. It's only when it starts sustaining above 270, then one can definitely look for a longer term. But for the short term, it seems that once above 255, it is headed towards 270, 75, where one can look to book profits.
Okay. Well, just 4 minutes away left for the markets to start. So let's tell you all that you need to know to stay ahead in trade today. Infosys delivers numbers in line with estimates, and the stock likely to start off just about marginally higher in trade.
Well, Capital First to be merged with IDFC Bank, and share swap ratio, as we discussed, is fixed at 10 shares for 139 shares of IDFC Bank.
HDFC to raise 13,000 crore rupees by selling shares to institutional investors via QIP. The stock starting off 1.5% higher.
While foreign institutional investment in team lease services and healthcare global reaches the limit of 24%, no further FII buying is allowed.
Religare Enterprises revises value of health insurance operations to 1350 crores over delayed sale.
While 3 initiations today, ICICI Direct sees 30% upside in Himadri Speciality, while Equator sees 12% upside in Whirlpool, and Geojit sees 11% upside in ICICI Prudential Life Insurance.
Well, those are a clutch of names. Ruchit, any thoughts on ICICI Prudential Life Insurance? A clutch of fundamental houses, including Nomura and a couple of others, have come out and said that ICICI Pru seems like a good buy. How does it look technically?
So technically, if we see, then recently the prices have corrected from its high of around 490-500, and post a consolidation phase again, the stock has started forming a high top high bottom structure. So I think the risk reward ratio is quite favorable to create fresh longs over here. But definitely one needs to have a positional view and not a very short-term trading view on this stock, because we have not been witnessing any significant jump in the volumes in the recent past. One can go long from a positional perspective of about 3 to 4 months, keeping a stop loss below some 370 kind of levels, and on the higher side one can expect levels around 450 to 460.
Okay, so that's the call coming in on ICICI Pru. HDIL is another interesting stock that we were discussing. Mukesh, if you could look at the technical picture out here, because promoters are willing to invest at 10% premium to current market price. Stock will probably open higher by 3.5%.
Pradeep, HDIL has got a resistance of this 200 days exponential moving average, which has been proving to be a bit of a bother for the stock for last 15-20 days. It is placed around 67, 68. So if the stock pops higher into that particular kind of price area, then once again we can expect a bit of a decline. But on the contrary, if this 67, 68 is taken out and then subsequently the initial half-hour highs are getting crossed in the stock, then this can be the trading vehicle for the day, at least towards the target areas around 77, 78. But key is this 68 area in this particular stock.
Okay, just before we start the trades, and maybe we'll take in final comment from Siddharth, Sedani after the markets start. But keep in mind that we are all set to have a start which is, well, about 1/3% in the green for almost all of the key benchmark indices. The question mark only is whether the Nifty Bank can outperform, led predominantly by HDFC Bank and some of the other banks which come out with numbers. And watch out for heavies like HDFC, which is likely to start off about 1% higher in trade today. But less than a minute to go, so let's nail it down to that one top idea for the day from both of our technical experts. Ruchit, one top call for you this morning.
Then you have to go for intraday position. Then I would recommend creating longs in ICICI Bank. We have seen that during the entire last 1 month, prices have consolidating, and 319 was a crucial resistance. Today, the stock is opening above that resistance with a gap up. So I think this should lead the prices higher, and also what we are talking about 25,800 resistance in Bank Nifty has also been crossed in at least in pre-opening session. So I would recommend going long in ICICI Bank for intraday, keeping stop loss below 315 and expect target around 327 to 330.
Mukesh, what about you?
It would be Hindalco. Buying is to be done around 269, 270, and stop is to be placed below 264 for an upside push towards 285.
Okay, gentlemen, stay on. Let's start the markets this Monday morning, and we'll start off about 1/3% higher as the pre-open rates have already shown. The question mark is, do we do more? The Nifty Bank about 0.5%, so it's actually a good start for the Nifty Bank. The Nifty to about 140, Sensex to about 145 points, so it's good going. Pull up the mid cap, small caps, and then the Nifty heat map. You will see some gains at the broader end of the spectrum too. But the heat map will show a fair bit of green and some heavies leading the charge, the likes of HDFC. ICICI Bank, incidentally, is the top gainer too, and hardly any losers. That's the key thing in today's session. A sea of green, lots of gainers, not enough losers. I just want to mark the three newsmakers in one go. Capital First, IDFC and IDFC Bank. IDFC Bank marginally lower, Capital First not seeing that huge upside of 12% at which it values it at a relative basis to IDFC at about a 12% discount. It's narrowed that discount a bit, so about a 1% gone from IDFC Bank, 5% up for Capital First, so that's about a 6% of the discount that's already been narrowed. Now, depending on what IDFC Bank does over the course of the next few days is what I would presume Capital First will move towards. Keep in mind, this is also because Capital First and IDFC Bank have rallied 15% ahead of the announcement. IDFC Limited marginally off in the session today. What about other individual movers? HDFC, Infosys, all of those are in news. But let's bring up some of the other stock makers. Analysts remain very, very positive on HDFC, naturally so. And this stock starts off about a couple of percentage points higher. So good going for HDFC in the session today. What else? The FPI limit has been raised for Granules India. That stock is about 2.5% higher. So good start for Granules India in the session today. Very strong numbers for Bhansali Engineering and Polymers. Margins have gone up. Net profit is increased. A stock is up about 5% in the session today. I just want to make a quick mark as to what's happened to some of the high flyers in Friday's session. I remember Den Networks was one amongst those. Gujarat Pipavav starting off well. First Source starting off about a couple of percentage points higher. And the index starting off at life highs, now at 10,726. So it's a good start, Pradeep. What else are you spotting?
Muthoot Capital, look at it, up by around 7.5%, close to 8% now. Hathway Cable also continues to move up. Interestingly, all these cable TV distribution companies were buzzing last week as well. You also have INEOS Stereolution, which is up by around 7%. That is interesting. Also, Kingfa Life Sciences is a small stock which keeps buzzing. You know, it has been moving last week as well. Then your usual suspects of like Skill Infra, GVK Power, IVRCL, all these infra names continue to move up. Also, Simplex Infra is up by around 5% in today's trade. Butterfly Gandhimati, that we discussed earlier, is up by around 5% as well. Sadbhav Infra has also gained in today's trade. Amtech Auto is up by around 5%. These are some of the stocks that have been buzzing for a while now. On the negative side, what is really correcting? Syntex Industries, as expected after weak numbers, is down 3i. Infotech continues to slip. Orient Paper down once again today, but I think this is for the first time when it's not locked at the lower circuit post the demerger. Also, if you look at Karnataka Bank, this is yet another buzzing stock which has corrected today, down by 1.5%, and Man Industries. So some of the gainers of last week or last session that are trading weak this morning.
You know what Capital First gains tell you is that because it's a 12% premium, but the stock has gone up only 5%, maybe there's some bit of a pullback that we could see in IDFC Bank. Keep that in mind. Don't just look at the differential of 12% and believe that Capital First will move up 12%. IDFC Bank is down 3% now. I'm not surprised that this is happening, simply because the market doesn't want to give a 12% premium to Capital First from the current price. And therefore, the way to reduce that arbitrage is bring down IDFC Bank as well. So some selling seen in IDFC Bank, some buying seen in Capital First. This now more or less negates almost 80% of that differential valuation that we had. Remember, Capital First will track IDFC Bank's stock price. in the near to the medium term now that the ratio is known. Okay, final thoughts from our experts. Just a quick, Mukesh, first a quick check on ICICI Bank or Indiabulls Housing Finance. Both of these are starting off very well. Is there a trade in either of them?
ICICI Bank can be traded based on this open chart gap which has been left in today's session. The stop has to be placed below 318 kind of, and on the higher side it is expected to move towards 329, 330 by the end of day's play.
Okay, so that's the call coming in here. Siddharth, before we let you go, a few stocks which have started the day with extremely high volume. If any of these are under your coverage, Muthoot Capital, Kaya, or look at Mahindra Lifespace, are you tracking any of these?
We are not tracking any of these. In fact, you spoke about Muthoot Capital. We have a buy recommendation on Manappuram Finance. We believe that Manappuram looks quite interesting from here on. One can expect, of course, there are a lot of say in the markets of takeover and all that. But I think financially also on the NBFC front, they are lowering from the gold finance space and focusing more towards NBFC side of the business. So Manappuram looks little interesting with a medium to long term perspective.
Thanks, Siddharth, for joining in today. Ruchit, before we let you go, any trades on any of the key indices? Nifty, Nifty Bank, all of them have started higher?
Yeah, I think if one has to trade fresh in index front, then I think Nifty Bank index could be traded now. Primary reason we discussed earlier that 25,800, which was the resistance, has been crossed. Secondly, it has been crossed with a gap up opening. We see heavyweight ICICI Bank giving a breakout from a consolidation phase with a gap up opening. So the entire underperformance which has been seen in the Nifty Bank index, I think that there should be some sort of momentum now coming in this index. And on the higher side, we can expect levels around 26,200 to 26,300 in near term. So one can go long in Nifty Bank index. I am giving the spot levels at current price level, keeping stop loss below 25,670.
Okay. Thanks, Ruchit, Mukesh and Siddharth for taking time out and joining us this morning. Now it's time to introduce our next big voice, Dhananjay Sinha, Head of Research, Economist and Strategist at Emkay Global Financial Services, is joining us on the show. Dhananjay, good morning. All eyes are actually on two or rather three stocks, Capital First, IDFC and IDFC Bank. What's the call that you have given to your clients post the announcement?
So I think we have a positive view on the merger. I think very clearly this is a merger which enables IDFC to have another leg of very strong growth, especially with the acquisition of the retail business which Capital First specializes in, and where it has actually grown rapidly in the past. So I think with the merger there is a possibility of inorganic expansion and a scalable expansion for the IDFC Bank. So I think that adds on to the future business of IDFC. So that's a good thing to happen. I think then the other issue is with respect to the retail deposit franchise. I think that is something that needs to grow. I think Capital First has a considerable number of branch network that can be utilized over a period of time. So that is one thing that they will need to grow going forward. That's not coming with the merger in the overall scheme of things. I think the third point that we have highlighted is that with the merger of NBFCs into bank, I think the statutory requirement with respect to CRR, SLR, etc., and priority sector lending will also increase. So I think in the near term, it is possible that because these statutory requirement pulls down the returns or margins in the near term. So I think there is a possibility of some sort of a marginal decline in the return ratios initially. But if you look at good 2-3 years down the line, as the business scales up, it is possible that the combined ROEs might actually move much higher to something like 15-17% is what we are expecting, which is much higher than the entities taken separately. So I think this is a good collaboration or a good merger. I think from a valuation standpoint, we believe that IDFC may have actually paid some sort of a premium of about 10 or 15 odd percent at 3.1 times FY19 book value versus the traded level of 2.8 or 2.9. So I think there is some amount of premium that has been paid. But I think what the merger is actually pricing in is a scaling up of growth, and I think our view is that the combined entity can grow. They have the sufficient capital, and they can grow in the region of something like 22 to 24% if you look at the book. So that's a kind of a growth potential it has. I think they have reasonably good asset quality, notwithstanding the infrastructure exposure that IDFC has. A good amount of that is actually, I mean, the impairment is reasonably provided for. So I think they have all the ingredients to grow as a combined entity.
So if you look at some of these candidates that have a potential to grow very fast in the banking space, if you had to choose between an IDFC Bank, an RBL Bank maybe, and a DCB, which one do you pick? Maybe there are more names that would be on your radar.
So RBL, I suppose is traded somewhat higher in terms of valuation. So I think with the merged entity, the valuation is somewhat lesser, and with the ability for it to grow, and if the assumptions we'll have to make is that the new management with Mr. Vaidyanathan coming in, I think the possibility of stronger growth will pan out. So for the valuation that is lower than RBL, for instance, I think it's a good bet.
Okay, so it's a good bet in private sector banking space. That's the call coming in. IDFC Bank will probably see some buying interest on fundamental basis. Just one call on what do you really expect from PSU banking before we move on to other sectors, because people have been expecting bottoming out, or rather topping out NPAs, and therefore kind of bottom in earnings. Do you think this quarterly number, December quarterly number, will actually reflect that, and we'll see upside over next month and a half?
I think it will be premature to actually guess a significant turnaround or price in a significant turnaround for the PSU banking space. We are looking at a scenario where the systemic growth has actually improved, and from that standpoint, if you look at the credit growth for the system, it has improved to something like 11% by end of December. So, and that's a high, much higher than 5% by, let's say, March end. So there is an incremental addition in additional momentum in credit growth that is happening. But I suppose this has largely been driven by the private lenders, and the PSU banks, though they will be on a better situation compared to what they were in March, I think they would still be lagging behind. So from a market share standpoint, they might still be losing. Number two thing is that the yield curve has actually steepened, with 10-year yield actually risen to almost like 7.4% or 7.5% now, somewhere in between. So that's contrastingly higher than what we saw in, let's say, mid-2000, somewhere around June, July 2017 at 6.4%. And our view is that a considerable amount of investment or trading gains were made by having a certain position in the GSEC market or GSEC portfolio, and that contributed more than 100% of the profit before tax for many PSU banks. So with the steepening of the yield curve and yields rising, it is possible that they will actually incur losses because of the steepening of the curve and fall in the value of bonds in their portfolio or in the SLR portfolio. Now, whether they will be able to translate operating profit much stronger than the impairment with respect to the trading profit is one thing that we'll have to be watchful of. My own view is that during post the demonetization and subsequently also that PSU banks had increased duration on the GSEC portfolio, and hence the possibility of losses from a trading profit standpoint is something that we'll need to be watchful of, and the operating profit may not be so strong. So that's the whole mix of the operating profit and the trading profit. And the other aspect is with respect to provisioning, etc., and NPA issues. I think that will continue to be there, though on a slow pace. It is possible that slippages might be somewhat lesser, but I think it is important that the recapitalization that has been announced, that is happening gradually, and I think the full impact, the partial impact of that will happen possibly in the March quarter.
Mr. Sinha, it's not actually only about the PSU banking. But isn't it surprising that our markets have been able to kind of digest the higher yields? We have been able to digest the crude at $70. Even today, right now, when we are talking, markets are at a new high.
Yeah, so I think for the market, the other aspect is the fact that you have considerable amount of cash lying with the mutual funds. I think there is a good amount of flow that is still happening, and I think it is sort of a back-ended thing because flows are a function of returns or performance of the mutual funds and returns of the market. So I think that momentum still continues, especially for the equity funds. Though we have seen that there is redemption for money market funds, so fixed income flows are actually moving out. But still your equity flows are strong. So I think from that standpoint, and that is one thing that has been holding on the market for the last 1 year in particular, and generally over the last 3 years. So I think that is one aspect that has really propelled the market in terms of valuation. So if you look at where the flow is going, it is largely into the mid cap and small cap space. So mid cap index has gone up to almost like 55 times trailing earnings. So that's a significant valuation versus the benchmark index, which is trading at something like 25, 26 times on a trailing basis. So I think the market has been holding on more because there is good amount of flows that has happened and continue to be there for the mutual funds.
Dhananjay, just wondering, from this whole set of new age sectors that have taken birth of sorts in 2017, where would you be the most comfortable in? I mean, consumption has seen the birth of, virtually the birth of dairy, so to say, or at least it's come into focus. We've seen both general insurance and life insurance come into play. And in a manner of speaking, we now have asset management into play as well, with both Motilal Oswal and Reliance Nippon Asset Management out there having the flavor of these businesses. Where do you find favor here?
So I think there is a good amount of opportunity for the financial sector, especially for the NBFC space that have actually got onto the market flavor, and many of these NBFCs have also, or financial entities have tapped the market. I would say that within the NBFC space, one has to be somewhat cautious because the markets have already run up quite a bit and valuations have been pretty high, and with the tightening of the liquidity and rise in yields, it is possible that many of the asset-backed NBFCs might actually face challenges with respect to maintenance of NIMs. I would prefer NBFCs which are sort of which are having shorter duration in terms of asset on the asset side. So these are largely in the space of consumer lenders. With respect to financial service providers such as JM, etc., I think there are good opportunities. Edelweiss is also there. So many of these guys have actually got good opportunities to grow profits through the ARC business, wherein resolution of impaired assets they have acquired or partially acquired and there is a good pipeline of that, will provide them good profit growth opportunities over the next 2-3 years, and they are building a pipeline of such assets, good quality assets. So I think there are good investment opportunities in the financial services space. With respect to mutual funds tapping the market, not very sure about those in terms of their sustainability, because mutual funds are cyclical business according to me. whereas some of the financial service providers good. With respect to, I think we also saw dairy products also getting a limelight last year, and that I think jives in well with our consumption theme. We have increased our coverage there, and I think that the story out there is value-added product and improving the asset turn ratio. So that's a gradual story. It will sort of provide returns over the next 2-3 years, and it's a gradual thing. It's not something that will one should not really look at a 6 months or 1 year kind of a view, especially for the dairy business, because it is a capital intensive sector. So that's a take over there. Any additional sector that you talked about?
No, I mean, I think this is the sum and substance of what I wanted to check about, Dhananjay, and take a moment to thank you for joining us today early morning and giving us your thoughts. Really appreciate. Have a great 2018.
Thank you.
That's Dhananjay Sinha of Emkay. By the way, just before we take that break, keep in mind ICICI Bank is the top gainer. Morgan Stanley has come out with that note. They've added ICICI Bank to the Asia Bank's model portfolio, and this move in ICICI Bank is a result of that addition by Morgan Stanley. 3.5% after a really long time. You're seeing this kind of a move in ICICI Bank. But we take a break. Coming up on the other side, we discuss the long-term capital gains tax possibilities and implications with Pranav Sayta of EY and Ketan Dalal of Katalyst Advisors.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Business news, we're news for business people. back. You're watching Indian Open. Now, in the run-up to the budget, we're going to talk today about that big controversial long-term capital gains tax expectation or fear, however you want to call it. In his 2004 Union Budget speech, then Finance Minister P. Chidambaram abolished the long-term capital gains tax on listed equity. That's equity bought and sold on the stock exchange. The effective rate went from 10%, if I remember correctly at that time, to about 0. Every year since then, the issue of reinstating that tax pops up with unerring accuracy before every union budget. In 2016, a month before the union budget, none less than the Prime Minister at a SEBI event suggested that those who profit from the financial markets are not making a fair contribution to nation building through taxes. And then he blamed the low or zero tax rate on certain types of financial income. Now, there was no doubt he was referring to the tax exemption that's available on long-term capital gains on the sale of equity shares. But Budget 2017 did not make any change. That was last year. Now the controversy is back, and it's anybody's guess if Budget 2018 will bring back the tax. To discuss the pros and cons, we're joined by Pranav Sayta, tax partner at EY, and Ketan Dalal, managing partner at Katalyst Advisors. And good morning to both of you. Thank you for being on Bloomberg Queen. I'll start with you first, Pranav. Simple, straightforward question. Do you think it should come back?
I don't think so. I think this regime has stood the test of time. The government introduced it with a very clear ideology of trying to have a securities transaction tax, continued for so many years. There is a simplicity to it. There is a certain element of tax without whether there is profit or loss. And this has stood the test for a long, long time. That being the case, I think it should be continued. Stability, predictability, lack of uncertainty is a big thing from a tax standpoint. And I would think that this uncertainty should be put to an end. And one should either take a stand one way or the other, but I would think in favor of stability and in favor of STT versus a long-term capital gains tax is what they should go with.
Mr. Dalal, do you really think it's a debate between STT and long-term capital gains tax?
So I think, Menka, I have a slightly different take from what Pranav said. I understand the stability, etc. part, but I think there is a case from an equity standpoint, and pardon the pun, from an equitable standpoint, there is a case for at least some kind of a concessional rate, if you will, on long-term capital gains. It may not be the full rate, but it should be some kind of concessional rate. I think also we have to look at it from a larger perspective. And the larger perspective is, I think the other rates need to be brought down. You cannot have a long-term capital gains and the rates which have been promised to be brought down from a long time, and we currently have them at 35%. You had those rates at 31% in 2010. 8 years later, the rates have gone up because surcharges and cesses have gone up. But on the long-term capital gain itself, Menka, I think there is a case to bring it there. I mean, for example, China has 20%. Maybe what you can do is to have the smaller investors exempt, given the fact that there is a lower equity penetration from small investors. So you can say, for example, that somebody who makes a gain of up to 2 lakhs or 3 lakhs a year on long-term capital gains will be exempt, because that will also encourage and incentivize the equity penetration. But over and above that, maybe at some graded scale, I think there is a case to bring it back.
Okay, let's see, Mr. Dalal, if we can convince Pranav with that. Do you believe that if it were to be brought back, but the smaller guy would be exempted from it, and maybe the better way to do that is to link it to your tax slab?
Sure.
Saying that, okay, if you are in the 30% slab, then you pay X% on LTCG, as opposed to link it to the quantum of gains in itself. Because, a big guy may make a small amount of gain in a particular year for a variety of reasons, but that still might be something that's tax worthy. So do you think if it were to come back, and if it were to come back only on the rich fellows, if I may call it that, then that might be something that you're okay with?
Okay, so let's put it this way. There are merits to a long-term capital gains tax, and one of the chief merits is bringing down inequalities of income, if I might say so.
And revenue collection in a year.
And ensuring...
when you're really nervous about revenue collection.
For sure. So I'm not too sure how much long-term capital gains tax is going to contribute to that particular kitty. Vis-a-vis, and I assume that when long-term capital gains tax does come, it will mean repeal of the STT. Because otherwise it would be a double whammy.
Or a set-off. Or a set-off. Can you do that?
I'm not too sure of a set-off, because if I suffer a loss,
I still pay STT. If I don't make a gain, I still pay STT, and there could be different things in different years.
Carry forward your STT payment towards
yeah,
the
so
gain.
I'm only trying to complicate the tax even more, and I'm not too sure that's going to achieve much of a purpose, because at the end of the day, we are talking of two alternative tax regimes. Either a tax on my total sale price or purchase price, as the case may be, paid once and for all, no questions asked, simple, stable. It has continued for so many years. I don't need to maintain, details of my cost of acquisition, year of acquisition, date of acquisition. It saves so much tax, so much time from a tax effort from a taxpayer standpoint, saves so much time from a tax administration standpoint, and I'm not too sure an analysis is done of how much they are going to collect by way of capital gains.
That's the critical question. So I tried very hard, because the government has in subsequent budgets been offering this revenue statement of revenue foregone on account of incentives and tax exemptions.
Right.
Now, they haven't ever spelled out, at least not to my knowledge, because I've looked through many budgets over the course of the last few days, they haven't spelled out specifically what is the revenue lost on account of this exemption that was introduced in 2004. But I can tell you the data with regards to long-term capital gains tax for the year 2014-15, and this is the latest data available on the income tax website, the total amount of long-term capital gains, not tax, long-term capital gains, counting companies, individuals, firms, HUFs and AOP BOIs, is 84,847 crore rupees. Now, if assuming that all that long-term capital gains was on account of equity sale and purchase, that too listed equity sale and purchase, not including real estate or anything like that, just a broad assumption. And if you were to tax that 84,847 crores at a nominal rate of 10%, which is 5% lower than the current short-term capital gains tax, you would end up with about 8,400 crore rupees. Now, I'll just bring up for you what we are collecting in terms of STT. In 2017-18, the budget estimate for STT was 7,767 crore rupees. So by this random calculation of mine, STT is fairly close to what long-term capital gains tax is. But of course, since then the markets have gone up even more. So who knows?
I quite understand that, and this is a never-ending game. Markets might go up and markets might go down. But the point is that this 8,400 crore calculation is like the maximum upper cap, because there's a lot of capital gain.
Yeah, I know.
For example, that is made by unlisted share sales.
Of course.
Other assets other than shares, etc. So I'm sure there's lots contained in it.
Yes.
And that's where I'm coming from, that there is undoubtedly a case from an equity standpoint that someone who earns a lot of long-term capital gains can't be expected to go scot-free versus a person who's slogging his way and earning salary income and pays all that tax. Certainly there's a big sentimental issue also there, that why should I be paying 30% tax when long-term capital gains are tax-free. But the point is, from a government standpoint, how much are they losing, and is the effort and putting the taxpayer through that pain really worth it?
Let's put that, Mr. Dalal. Mr. Dalal, I don't know if you agreed with my calculation. I must admit it's very, very back of the envelope, as they say. But if you were to believe in it, then the potential, sort of gain in 2014-15 at least on account of LTCG would have been somewhere around 8,000 crores if all of that LTCG was equity oriented, and STT collects about 7,700 crores.
Yeah, Menka, I don't know where this figure is coming from, and it's very difficult to make estimates, because as Pranav said, the market may go up, the market may go down.
Mr. Dalal,
but
income
the
tax department data, 84,847 crores in long-term capital gains in 2014-15.
No, I know that. Yeah, I saw some other estimate, Menka, and I think that was put out by the BSE, and I don't know what basis they did that. They came to a number of 49,000 crores. The 7,700 crores was 49,000 crores. So I don't know where that is coming from. But in reality, Menka, what will happen is today you have the market as almost 35,000 on the BSE, Sensex, and it's at an all-time high. And we don't know whether the people will make gains or will not make gains. And also remember that if you have to pay that tax, many people prefer to hold on. So it's very difficult. So I'm not really on the calculation, although I suspect that it will be logically significantly higher than the 7,500. Given the fact that you have prices of stocks at the place where they are. But I am on more of a general principle that there is some case to tax it, maybe at some concessional rate, and maybe, as you said, that the smaller guy, the guy who pays, let's say, 20% tax rate, he could be exempt, or maybe a combination of a particular quantum of gain and a particular tax rate that he will be taxed at a lower one. And as you go up the value chain, so to speak, you pay higher and higher taxes, and maybe the maximum cap could be 10 or 12.5, something like that. Because in any case, as you said, short term is 15. You never know. They may actually get the short term to 20 and this to 12.5. You never know that, but just as a matter of concept.
I would like to interject there. I might say one thing, that irrespective of what the decision is, it should not be based because the markets are where they are. That's completely unfair, I think. Because when there are losses suffered at the market, you continue with STT. Suddenly, in a year when the markets are looking good, you want to bring in that. Philosophically, I am completely against. If you want to bring in a capital gains tax and substitute STT with a capital gains tax, that's fine. But let it be stable thereafter. It can't be that when markets are really doing well, you levy a long-term capital gains tax.
It would be only a 1-year measure or a 2-year measure.
I agree.
Now, if it comes back, I imagine it will come back.
But since that point is coming up again and again, that the markets are where they are and so on, I don't think that should be a dictating or determining factor. It should be the philosophical view that you carry. Whether STT is the appropriate form of taxation, it has virtues of simplicity and so on and so forth, stability, or you want a capital gains tax. But it should not be because of, the trigger should not be where the markets today are.
Yeah. The other angle, of course, is what it does to sentiment while we are trying to get this equity cult and retail is coming back. What does all of this do? But that's a separate discussion altogether. One other point that has come in the realms of discussion is rate tinkering. Even if LTCG doesn't come in, what happens if rates are tinkered, if at all STT rates are tinkered a bit, or STCG, the time duration is taken forward from the current 1 year to a higher threshold as well. Any thoughts thereof? Because either that move, those moves also from a market perspective are kind of disturbing the market sentiment for sure.
No, sure. So that's where I have felt that 1 year to determine long term is just too sweet. That's my personal view. I don't think by any benchmark will anyone agree that holding something for 1 year makes it a long term.
Last year they brought 3 years on real estate down to 2 years, right?
No, that was on unlisted shares.
Okay.
Basically, that brought it down to
So
2
you're
years.
saying if it was LTCG on, let's say, holding, if LTC was exempt on holding above 2 years or 3 years, you're okay with that kind of treatment?
Yeah, philosophically, I don't quite understand why for a listed shares it becomes long term after 1 year, for an unlisted share it becomes long term after 2 years, for any other asset it becomes long term after 3 years. That seems to beat me, the logic. I mean, if you want to promote the equity cult and so on for a certain period of time, it was fine to bring that in. But I am not able to fully justify a 1 year for a long term capital asset.
Yeah. Mr. Dalal, do you think this really will impact, as they put it, foreign investor sentiment when it comes to the Indian equity markets? Because, there are two things here. One is that all I've ever heard you and Pranav and all other tax experts and all other FIIs saying, hey, look, we don't mind paying taxes as long as you make it predictable and stable. The second thing is that we saw big changes happen to the Mauritius and Singapore treaties, and now commensurate changes happening to all the other treaties that India has, tax treaties that is, and it didn't change the FII sentiment in any dramatic fashion. They're not making decisions based on that as long as they know what the tax architecture is. So do you think this could have an impact on FII participation?
Yeah. My sense is, Menka, that it will have limited impact. If you look at the foreign investors on the stock market, I would divide them into two baskets, the FIIs on the one hand and the private equity on the other. The private equity are usually not trading, so to speak, or churning the portfolio as fast as the FIIs, and FIIs is anyway the major one. You mentioned about Mauritius and Singapore, and while I don't remember the numbers offhand, I think about 60% of the total investments were anyway coming through Mauritius and Singapore, and subject to the grandfathering up to 31st March, the new investments now are liable to tax. If you make an investment after March 17 and sell by March 19, both under India-Singapore or India-Mauritius treaty, you will pay that tax. But of course, if it is long term, you will anyway not pay because of domestic law. Coming back to the question itself, I think the impact will be limited, but I think the tax rate at least should be low, at least in the initial stages. So for example, if it is say 10%, it could be 5 in the first year and 10 in the second year, as opposed to doing everything at one shot. I think that's the way I would look at it. I also want to make one more point. When you look at capital market tax changes, maybe you can also look at the dividend distribution tax, because today what is happening, an investor who borrows money to invest in shares does not get a deduction of interest because dividend is considered to be tax exempt. But it's not, it's economically taxed. But because technically the company pays DDT, you don't get interest deduction. So I think why you may think of bringing long-term capital gain, also make interest deductible, because you cannot have it one way. I think that, so I think the point I'm trying to make is it needs a little bit of a holistic look as opposed to a siloed look.
You know, but Mr. Dalal, at
and
a
maybe
time,
even the losses should be allowed to be set off more. Yeah.
No, at a time when revenue is hard to come by, I'm sorry to have interrupted you, but at a time when revenue is hard to come by and so much of the political pitch is towards equality, and we are going into, you know, an election year very, very soon, giving the guy who borrows money to buy shares or do any of those things, you know, any kind of set off, I'm not even sure how well it will sit with the folks at the finance ministry. I have just one last point to make to Pranav, because I know he started.
No, why
go ahead, please go ahead, Mr. Dalal.
No, I think Menka, I don't agree with that point. See, what do you tax on? Profit. If you are borrowing money to invest in shares, the profit is reduced to the extent of the interest. So what should you tax on? The net, right? I mean, I don't see any reason, and I'm not saying there'll be a huge amount of interest deduction, but if you are expecting him to pay on the capital gain, you should at least give him an expense that is related to that gain. So
yes, of course. If you're expecting him to pay on the capital gains, then all this should follow. Yeah, okay, I get it. If you're expecting him to pay on the capital gains, especially if you're restoring long-term capital gains, then all of this should follow. One last point, at least from my end, Pranav, and that is that I know you made the point that, oh, STT is an easier tax to collect. LTCG we've seen in the past has been fairly litigious as well. Easier to collect, neat and tidy, etc., etc., etc. But it's also very unfair tax, not just from the equality point of view, but if you look at the direct tax, indirect tax ratios, I think you'll see that in this country, indirect tax is the much higher contributor than direct tax is. And in fact, in most parts of the world, especially the developed world, it should be the other way around. It's individuals, you know, that earn a higher income that should be paying more tax, as opposed to trying to collect more tax through the entire population having to pay. So won't these elements go towards helping balance all of that? So helping earn revenue, helping to some extent balance that direct indirect bit, helping rationalize these many different years for LTCG 1, 2 and 3. So suppose the finance minister says, okay, 3 years is long-term capital gains. Anything after 3 years, you can get an exemption. Anything sold before that, these are the STCG rates. Wouldn't all of that actually sit rather well from a rational point of view?
Yeah, so as I said, enhancing the limit for the asset to be long-term, including listed equity, to maybe 2 years or 3 years seems logical to me. As regards your very valid point that the direct tax to GDP ratio in India is way below what one would have liked it to be, there's no doubt about it. I'm not too sure how much a capital gains exemption withdrawal and substituting STT with it is going to contribute to that. Vis-a-vis the simplicity, stability, predictability point that we are making. Yes, what we need is enhancing the tax base, trying to ensure more trust, more compliance, you know, so far as direct taxes are concerned, and a better, cleaner and efficient administration, which will bring up the direct tax to GDP ratio, which I think is really the need of the hour. I'm not too sure how much this capital gains tax will contribute to that.
As they say, every drop, you know, makes an ocean. So I'm only just, you know, pointing out to the various inequalities in the system, and therefore this might help correct all of that. Besides get revenue, besides look, you know, politically correct to do all of those things. Right?
And you are right. This might contribute to some small measure in improving that ratio as well. But whether that is really worth it, given what you are otherwise giving up. And in a year when markets are not good, probably the ratio might even fall, because today you are collecting STT, tomorrow you won't. So I'm not too sure how much this step is going to contribute to that particular improvement in that ratio. But rather, there are many other things that really need to be done, sooner the better.
Now, I just wanted to you know, ask the question that Menka asked Mr. Ketan Dalal as well, Pranav. domestic institutional investors haven't really seen, or at least the people who are investing right now haven't seen cycles. So we haven't seen the behavior of a domestic investor, retail guy who's come in a big way in 2017 through tough cycles as well. So FI flows are important. My question is, in a year wherein we'll be battling for flows versus with other countries, wherein US doesn't have long-term capital gains tax for foreign institutional investors, Chinese shares, you kind of make do with it by buying Chinese shares listed on the global exchanges as well. If India brings that, is that impediment to FI flows coming back? Because in 2017, we've seen a bit of a withdrawal of FI flows already.
I think surely there would be an impact. How much is very difficult to predict. But my feeling is there will be an impact, especially when you withdraw treaties. You are trying to tell investors that when you invest, you pay STT. When you exit, you will not be liable to capital gains tax so long as it's long term. You suddenly withdraw that step. Last year, I know what the Prime Minister did say, but Arun Jaitley very quickly clarified as well. The budget did not contain any of this. Even while the treaties, protocols were signed and so on and so forth, this was very much there. So I think it's more about the simplicity of it, the stability and predictability of it, and a sudden withdrawal is not going to be taken too well, is my feeling. How much that impact would translate to is very tough to say.
Yeah, I think, just to close this out, I think three things, and I'm sure both our guests, Mr. Dalal and Pranav, will agree. A, we should know really what is the potential revenue gain by reimposing this tax. B, you should know whether STT should go away if LTCG is brought back and standardized to make it 1, 2 or 3 years. Ideally, 3 years makes the maximum sense. But STT, I think Pranav and both Mr. Dalal would agree, then needs to go because you can't have the both sort of coexist. I think those two things are absolutely critical when it comes to being able to introduce this effectively. And the last one is, I think Pranav makes a fair point. If you invested in equities expecting a certain tax framework, it cannot be implemented retroactively. It has to be prospectively, which means every share bought after the budget announcement and not applicable to any purchases before the budget announcement. That, I think, would be very, very critical from a market sentiment point of view.
I think that will be a big boogie if they do it retrospectively. That would probably...
No, but they might say that when you sell, retrospective is what? If you sell any time after the budget, now it applies to you.
But, No, Menka, people would have bought in knowing that...
Or you hold for 3 years after the budget. Maybe the time clock key. So it's all these things will matter in how people observe all of this. Gentlemen, thank you very much for joining us this morning. Like I said, every budget this comes back. Let's see what Arun Jaitley does in budget 2018. With that, we're wrapping it up here. Up next is the FNO Show.